that is part of the. It's part of the job, I guess, of a HFT, is to ensure that sort of efficiency through information dissemination. And the faster you can do that, the better. HFTs in general will want speed for one of two reasons, which we've sort of touched on. One, they want to be able to take opportunities where they see them. But importantly, particularly if you're a sort of liquidity provider from a proprietary perspective, it's often slightly misunderstood around why you want to be fast. And there are memes around, market makers front-running people, but it's not true. We like these types of businesses want to be able to remove orders, cancel orders, and it's usually because they understand where the fair value of an asset has moved to, and they have orders that are not reflecting that, and they need to get them out of the market as quickly as possible. That is the key reason why speed's important.
Hello and welcome to another edition of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, hedge funds, asset managers, and other institutions are doing in crypto and how they're doing it, this is the place for you. My guest today is Tim Meggs. He is CEO at Low-Tech, also known as Low Observable Technology, a London-based firm focused on trading, low-latency trading, market making, and data services. Tim has quite a deep career in trading, having been at Fulcrum Asset Management as a partner and head of trading, and also in quant trading at Dexterity and Maven Securities. He spent 10 years at CIBC and has covered almost everything in the options and derivatives market. His education, however, is slightly different, since he studied philosophy, politics, and economics at the University of Oxford and the University College London. Tim, welcome to RULEMATCH Spot On.
Thanks very much, Ian. That makes me feel seasoned or old. But yeah, a lot of experience which we're bringing to bear in the business that we're building now.
So, Tim, we're going to dive down deep into all things trading, market making, quant trading, low latency, all of that kind of stuff. But just to start high level, when it comes to liquidity in the markets today, I'd like to get your hot take, so to say, on where we are with liquidity in crypto markets. What are you seeing from Low-Tech and your position in the market?
What we see at the moment is the markets are waiting. Right? There were two dominant narratives that occurred across 2024. We had the approval of the ETFs, a huge boost of validation and interest into the space as a whole, and it had been quite well sort of introduced, the concept, but it was a long time coming. And when it did, I think there was a lot of relief and some very good flows into the market as a result. I think the various launches ended up being the biggest ETF launches that had ever occurred, which is incredible. So that was the first dominant narrative. And then as we got towards the back end of the year, we obviously had the focus on the election and which way that was going to go and what that meant for the space as a whole. With Trump winning, I think the market got very excited and we saw high prices off the back of that. But now, since then, since the announcements around SEC and AI, crypto czars, we've had this period, so Christmas gets in the way, but we've had this period of waiting. And I think the waiting is premised on whatever President-elect Trump comes in and does on his first few weeks with respect to crypto as a whole. So executive orders have been talked about. There's lots of rumors going around. And as a result, the flows, the volumes haven't quite been as strong as they were across December and particularly up towards the end of December, which is where we usually have sort of window dressing with respect to marking to market and taking realized profits, etc. And so these first few weeks have been a bit less exciting from a sort of price perspective, but have also been susceptible to some of the bigger macro pieces of information that have come out. And so I think, we have to remember that crypto digital assets as a whole is still a risk-based asset class. And so when there's not a dominant narrative or when the market's waiting, we see them being affected by other announcements, and slightly more hawkish tone from the Fed has seen the prices come off quite a lot, which is to be expected. I think we'll see some clarity come through from the administration, the new US administration, in the next couple of weeks.
And when it comes to the market, I mean, I know you're looking at things across the board. So some people talk about a Bitcoin season, some people talk about an altcoin season. Do you notice those changes or those differences between top-level tokens, the highest liquidity tokens, and then further down the charts? What are you observing in that sense?
There's always the first realization of macro themes happens in Bitcoin and Ethereum, and then we see trickle down to the second tier and third tier. The long tail tends to operate in a world of its own, and that can be driven by all sorts of things that are going on from a technology perspective and an innovation perspective. But when macro events occur or macro news happens, the action we see happens in the top 2 or 3 assets, and then as that ripples through the crypto economy, you see the same effects happen in the second and third tier. But yeah, I mean, if people want to move large sums of money off the basis of some news, it tends to happen in Bitcoin and Ethereum. They're just the most liquid. They trade almost everywhere, and so price discovery and execution is a lot easier there.
We'll get down into some of those observations that you might have, since I know you're doing a lot with market data and things, not just in the top tokens, but further down. You alluded to institutions in the ETFs, and that's the theme since that was just about 1 year ago. Huge numbers, record-breaking flows in those ETFs. How much do you think institutions, whether in the ETFs or otherwise, have affected the volumes, flows in crypto markets, in the liquidity, in the top tokens or in lower down tokens?
You can't deny it. We were just talking about having been at conferences a lot over the last 3 or 4 years. The narrative consistently at the more institutional focused conferences for years has been the institutions are coming, and they had to some extent mechanisms to do that once the CME listed its futures. You've got to bear in mind what the incentives are of these big trading businesses, whether it's hedge funds or banks or money managers. They need to do something which can get past their investment committees and their compliance committees. And so they need to have a vehicle which is ticking all the boxes in terms of regulatory approval. And so initially that was CME Bitcoin futures. But with the ETFs, you open up a whole other class of investment, both from retail all the way through to large equity-based businesses which are very used to trading ETFs now. When you think about what the ETF complex has done as a whole, it's been a great mechanism for businesses to gain exposure to things which aren't equities, but with an equity mechanism to do that. So that approval was a game changer in terms of the amount of liquidity that came into the crypto space. And so people worry in general, it's the ETF, it's on trading on exchanges, it's not going to flow through to traditional exchanges, it's not going to flow through to the crypto side of things. But the people that are making the markets in the ETFs have to hedge that exposure or gain that exposure somewhere else. So the trickle down to the crypto exchanges happens as well, as you well know.
And those are some big names that are doing that market making, supporting the ETFs and so on. And
they've been there for a while. Yeah. Like, this is not a new thing. We know a lot of the big APs, the authorized participants, have been around doing crypto in various forms for a while. And yes, as the ETFs gained approval, got listed and launched, they were heavily involved, obviously.
And besides those just people coming in, buying the ETFs and that's kind of flow coming in, are there other things, just thinking about liquidity, that are also changing, supporting greater liquidity? We'll get into it more down the road, but just at this point, people doing more arbitrage, people doing more fast, low latency trading. Where are we now with some of that?
I mean, the space continues to evolve in that dimension in terms of speed and consistency of quality of execution. This was something that I think was inevitable. The piece that remains within the crypto landscape is that still the dominant crypto native exchanges, for the large part, execution is done still over the internet or WebSockets or REST, but it's still internet based as opposed to leased hard lines into exchanges. This will change. It will continue to change. We started, really sort of Mt. Gox, Bitfinex 2015, 2016, with an incredibly fractured environment. And if you looked at that space, then you could see that there was a lot of evolution to occur here. And it was in the context of more exchanges popping up all over the place all of the time. And so there needed to be players like us, but also like other big established firms who tie all of that together. That's becoming, and will continue to be, more competitive. It's becoming, in a weird way, not easier to do, but it's becoming more efficient, right? So as everyone looks at this, the arbitrages are beginning to shrink, and the efficiency around price discovery is continues to get better. So yes, you will always find trading firms interested in places where they can have improved latency, often for reasons that people don't think of the first and most intuitive reasons. It's not always about sort of taking arbs on both sides. It's usually about being able to cancel orders quite quickly so that you can get out of the way as moves are occurring. But yes, that has helped established players, particularly ones that are from the TradFi world that might be coming to it a bit late, gain comfort around the ability for them to execute. It's a very different environment for some 2014, 15 when you'd send an order off down an API and you'd have no idea what was going on with it. Yeah, where is it? Did it make it? Am I being filled? Yeah. So.
Not exactly institutional grade, so to say.
No. Yeah. And still, to some extent, it exists when you're trading on crypto native venues that you access via the internet. There can be periods of high stress on that networking that give you some or quite a lot of degree of indeterminacy around what's happening with orders. And so you have to understand that and control that risk within your infrastructure.
We'll get to the risk management side a little bit later, but just talking liquidity and more specifically to what you're doing at Low-Tech, ensuring liquidity, part of that is market making. At RULEMATCH, we work with designated market makers, so that's always there, dedicated, guaranteed, so to say. With what you're doing at Low-Tech, this is in the market making space, then trading also as well. What is the goal overall of what you're trying to change or implement or push with Low-Tech?
Really good question. So if we step back right to sort of a 10,000 foot look at what we're trying to achieve with Low-Tech as a business, we've seen one evolution in the trading space and one major technical evolution from sort of 2002 through to about 2012, which was the pure electronification of most asset classes in terms of trading. When I first started, long time ago, I don't want to say the year, working at a bank, we were still sending equity orders, either phoning up someone up to get it done, or sending it on a spreadsheet, and they'd send it back half an hour later, with all the information around it.
Talk about a time lag. Yeah.
Yes, yeah. And with various regulation that came in and various technological changes across the sort of early noughties, you saw a huge fracturing of the equity landscape, but also FX was similar. And the ability for firms to execute electronically. And that cascaded out to the other asset classes eventually as well. And so you had this huge electronification of trading, which led to HFTs becoming the dominant liquidity providers in general. And it removed a lot of the existing incumbents, which were a lot of the big banks, money managers, and it became situation where you had a lot of proprietary trading firms being the counterparties that you would execute against on most exchanges. Tech first, yeah, completely. Huge users of technology to be able to scale. There is now a second shift that's happening, which is the evolution of trading activity from off-chain to on-chain. And so, for reasons we talked about earlier on, you will see a blockchainification of all trading activities. And as a firm, low-tech is building for that future. So we are building to be a full capital markets player as all of the rails are converted to being on-chain. And there are a number of business lines that we can layer on top of that infrastructure that we're building. And one of them, as you alluded to, is market making, particularly market making as a service that we offer to projects that need good market making on the venues where they're listed. And so we've launched that at the back end of October. We've had a slew of interest from our potential clients and the clients that we've taken on. We're doing it in a slightly different way from the way that it's done by a lot of the incumbents. But it's just one of the sort of several businesses that we're layering into low tech, all premised on having this technology which can operate across centralized and on-chain venues, even directly into smart contracts. So that's what we're trying to do. We're building for that fully on-chain trading future.
Mm-hmm. And who stands to benefit most from what you're building now in the phase right now? Maybe not looking too much into the future yet.
So there's sort of two business lines that we've stood up on top of our technology. The first is a very good market data business. So the first thing you need to do as a capital markets firm, but particularly as a trading firm, is to be able to get market data in. And often still in crypto, it comes in different formats from different venues. An AMM produces information in a different way from, say, Binance or OKX or RULEMATCH. The information comes in a certain shape and down a certain pipe. To be able to do anything from a trading or logic perspective with that information, particularly when you're comparing two venues at once, you need to be able to normalize it to make it look the same shape and compare numbers like for like. We do that as a trading business. So first we have to connect to all of the venues that are of interest. Then we have to do the normalization. And then once that's done, we act on it, but we also store it. And in storing it, we can then use it for research and simulation of our systems, replay of our systems, and quant research to improve everything. This type of data, the normalized multi-venue data, is of a class that we'd bought from people in the past. And so it was a small extension for us to be able to offer that to clients and say, look, we're a trading firm. We make sure our data is really, really good quality. And we can make it available to you and deliver it in a format that makes sense for you, whether that's large amounts of data at end of day, so you can have a view of what happened completely, or whether it's live, normalized, comes into us, we normalize it from lots of different venues and then goes out to you with a fraction of a millisecond of a delay. So that was the first piece that we stood up on top of this. And so trading firms, compliance platforms, exchanges, they've all come to us and said, like, we understand what you're doing as a trading firm. You've got a quality there which is a very good standard, and we'd love to buy your data. So that was the first one. And then the second one is, as the technology, as our infrastructure has evolved, we've been able to go to token projects and say, look, we think that market making for token projects as it's being done currently is not necessarily the best alignment of incentives. Yours as a project, theirs as a market maker, and theirs as an exchange. We've built a product which tries to solve that problem. And again, it's receiving a lot of good traction. So those are the two that we've stood up currently.
I imagine this is where the term ethical market making comes into play. I noticed that on what you write publicly about what you're doing. Just talk to us about what that means. And then, of course, we have to know the counterfactual. What is the unethical market making? What has been and what are you working towards in that space? Yeah,
it's a term we use a lot, as you point out. And what we're trying to convey with that is to highlight that when we engage with a project or a venue to provide liquidity, we're providing a service, which is in essence a combination of our infrastructure and, to a small extent, our expertise in terms of trading. And in providing a service, we want it to be of a standard that is value additive for the client. We want to improve their outcomes as a result of them using our service. And importantly, we want them to be able to see that. We really, really want them to be able to see that having engaged with low tech, they can see a before and after in terms of the behaviors that they're trying to improve. And we think that's the ethical way to behave as a service provider. What we've found, certainly from our initial token clients, was that market making agreements that they had with some of the incumbent market makers were structured in such a way that the incentives of the market maker and the incentives of the token project were kind of divergent. And that led to some not great outcomes for the token project, particularly in terms of how that manifested through price. So we see token price being affected by the deal structure, which we can talk about in more depth if you'd like, particularly around options plus loan as a way of paying a market maker. And then almost as importantly, often these projects are just left in the dark. They've engaged with a market maker. They have no really easy way of determining the improvement as a result of that engagement. That yes, they might be sent a weekly PDF report, or they might be sent a monthly summary of the trading that's happened by the market maker. But these token projects are building their own business. They're building their own communities. They're often very busy and stretched and tight. They're often startups. We found that the time they were having to take to understand what was in these reports and understand whether there was a quality of service being provided was just inordinate relative to where it should be. And so the early clients that we've taken on and all our new clients get access to a very simple live dashboard that allows them to see our trading activity in real time, but also whether we're hitting the KPIs that we have in our agreements. So if you're a token founder, you can log in, or on a token team, you can log in. It takes less than a minute to see if we're doing our job, and you can see the before and after quality. So we hope that that's something that's the right thing to do from an ethical perspective. You know.
And I'd be just interested to know how much of what you build and what you are building in that space builds on kind of best practices or history from other asset classes, where you have, big firms, but then people with certain responsibilities and rules in place where they have to act or should act ethically and so on and so forth. So you are bringing some of that into this space.
That's exactly
as
it.
Well.
Yeah, and it's like we're building with a view. We're building under the idea that everything we do will be looked at, either now or in the future. Someone will look back and go, "Were you acting in the right way?" I don't think. Hopefully, we don't exist in a world where there's going to be huge retrospective actions from regulators in the future. But we think that's the right way to conduct business. Can I stand up in front of someone and say, the decisions that we make and the way that we behave and the structures that we put in place are good for the client, constrained by our own requirements in terms of revenues and regulatory requirements. But yes, a lot of that in terms of how we've approached it has come from, unfortunately, a very long career in traditional finance, and
but lots
being,
of experience.
Yeah, FCA regulated at various points in my life, and understanding that there's a way to behave that people expect and that is just right.
Mm-hmm. And when you say the right way, then of course part of that is the tech, the processes, and as you talked about the format of data, simple, transparent. How much does the tech influence being able to do it the right way? We can't operate if we don't or haven't put the foundations in the correct way. And I'm lucky because my co-founders and I, the three of us, we have an overlap, which is a very nice sort of Venn diagram of skills and experience, whether it's pure quantitative trading or development based. And we've all had experience in traditional finance firms that have allowed us to see best practice and understand where in previous roles, previous parts of our careers, we had frustrations, particularly around data and access to data and ability to use it quickly and easily. You talk to any sort of quant-based data scientist or similar, and
it's very easy to get them ranting about the cleaning and lining up of data they've had to do just a simple research task. And where that might be sort of 20 to 30% of your research time is spent, moving data around and getting it in the right shape and making sure it's all consistent. When we first started our business, wanted to shrink that down to nothing, literally just be able to tap in the venue, the coin, the date range, and get back something which is consistent and easy to use. And so putting that in place from day zero has been a big multiplier on our business. And now some of our clients benefit from that data as well.
So then going back to just what I asked earlier about who can benefit from that, obviously the project themselves, they get clear insights on what's going on and how the market is being made for what they have. On the other hand, funds, people who want to run strategies and so on, they benefit from the output of your data, which then, should lead to greater liquidity, which should lead to more things happening overall in each particular market for each particular asset.
Just raising the quality of the ecosystem as much as we can by offering services that are of institutional standard, if not, better than what you might be able to get in traditional finance from traditional vendors. If digital assets as a whole is going to be where we all conduct our trading in the future, although maybe not obviously, then you want to see continual improvement. And so we're just trying to set the bar as high as we possibly can and ensure that, as you said, sort of institutions can get good data to make decisions on. And when we provide information to our clients on the trading basis, it's based on a quality of data which is just as good as it can possibly be.
And going back down to the tech itself, without asking you to give away too many secrets, but you mentioned some of the tech, WebSocket, REST, some of those things that have been out there built with. Up until now, some of it works kind of, depends on how you want to use it. What things did you for sure have to change or do differently to build what you want to build and to provide the services that you want to provide, going beyond what has been used in the past?
Yeah, so we wanted everything inside our system to be consistent, dependent, sort of irrespective of where the actual trading is occurring. So if we're managing balances on an AMM or if we're trading on an AMM, we want our system to receive that information once we get that information in. We want to normalize it in a way that that piece of information is exactly the same shape and format as similar information coming in from a RULEMATCH or a Binance or an OKX, so that we can categorically make like-for-like decisions. That was something that was key. Across the three of us co-founders, we'd all worked in places where previously we had sort of a centralized trading stack, which operated against exchanges, order books, known sort of structures, and then separate sort of infrastructure which operated against DeFi, AMM, on-chain things. And that's painful. So we wanted to build a system which was able to do both and only had to specialize right at the very edges where an API integration happens. And similarly, when we do an integration against a venue or an AMM or a smart contract, we want that to be a minimum amount of engineering lift. And so we're able to quite quickly integrate against a fixed protocol or a WebSocket protocol or a REST protocol or an RPC endpoint. And that's nice because that is pushed right to the edge of the infrastructure. Doesn't mean it's not important. It just means that once that integration is done, everything else inside doesn't have to be touched.
And you obviously make it easy for somebody who knows this or that, Fix versus WebSocket, to kind of get all together at once. Institutions in general have used more Fix and things like that, but you stand in the middle and kind of make things easier.
That's the hope. For us, we're not yet providing services to institutions, but things like agency execution algorithms might be on the roadmap one day. OTC streaming will be on the roadmap one day as well. Again, it's all predicated on a core piece of infrastructure that we have in place, and will evolve as those business lines get layered on top. Part of the role of a capital markets firm like ours, crypto capital markets firm, is to do the heart of engineering against all the different sources of liquidity in the space, so that your clients can interact with you, us, low tech, in one simple set of transactions, one simple set of integrations, and they don't have to worry about the nitty gritty of doing all the integrations against all the venues.
Sure, yeah. And that helps also for risk management, that data clarity, which is, shall we say, something that people at FTX maybe didn't think about too much. Other people thought somewhat about, maybe people think more or less about it, depending on whether it's a bull or a bear market. Institutions for sure think about it a lot, all the time, day and night, right? So
for a firm like ours, we need to have, as you said, a clarity on the trading that's occurring as a result of our systems operating. And we need a golden source of truth, which is easy to interrogate from a risk perspective. So yes, exactly to the point you're alluding to, all of the data within our trading system is the same data that feeds part of the risk system that we run. We also, for safety and redundancy perspectives, have a separate piece which interrogates our sources of trades, so our venues, separately from that, so that if the two get misaligned, there's all sorts of alerts and actions that trigger off the back of that. But from a firm perspective, internally, risk system, trading system, all operates on the same data.
And just on the back of that, what would you say is kind of the state of risk systems for market risk in crypto? Is this a well-developed space?
It's a good question.
At the moment, or still a big opportunity?
I think there are platforms out there that are offering good portfolio management, PMS, OMS, and EMS solutions. We haven't looked at them particularly closely because we have, across the skill sets within the firm, a degree of experience which, in building those types of products previously, that has allowed us to build our own for low tech. But it's a necessary function that people can offer to large institutions that I think is appreciated. Again, it usually comes back to the idea that you want to be able to see like for like risk information. So when you have a BTC perpetual, for instance, that might be coin margin, so has a degree of convexity in it, relative to a BTC spot position from a different venue, you need the risk system that you're using to be able to recognize the differences and the different risks that are there. We've built our own at Low Tech. We're not offering that to clients yet, but you might have just come up with a new business idea for us. But there are businesses out there that are doing it. They're well funded and they're getting traction as a result. I think it's interesting to, there are obviously some very big vendors of these types of systems in traditional finance. How they approach this burgeoning asset class to layer it into what they do is interesting. We're working. One of our data clients is not a live risk platform, but they're a compliance platform which do trade surveillance and post-trade analysis to some extent, and they have a requirement for very granular, well-sourced crypto data. And so these businesses are now getting the calls from their clients that are saying,
looking for what
can you offer me, trade surveillance or market abuse surveillance on these types of asset classes as well, which is great.
Something that we also think about at RULEMATCH. But,
of course.
Shifting gears just a little bit, not so much the services you're offering other people, but what you're doing as a trading firm yourself, and not in a slow manner, but quite fast, as I understand, with pretty speedy tech, HFT, something that's been around for a while in TradFi, as you know, but not so much in crypto. Do you feel like an old timer or a newcomer when it comes to trying to ramp this up? at this point?
I think the majority of the TradFi HFTs have been in crypto for a while now.
Of course.
They tend to, as businesses, they tend to move to where opportunity is, particularly if it's a game they feel they understand and might have an edge in. And so I feel like an old timer because I've been watching this evolution happen for a long time. We will push our technology to be as fast as possible in the venues where we are, purely because we have to do that to stay competitive. And the byproduct of that for the space as a whole is felt through improved price discovery. So the dissemination of information across multiple venues more quickly leads to better decision making, and you don't get one venue up here with the price when 90 of the venues have moved down over here. That is part of the it's part of the job, I guess, of a HFT, is to ensure that sort of efficiency through information dissemination. And the faster you can do that, the better. HFTs in general will want speed for one of two reasons, which we've sort of touched on. One, they want to be able to take opportunities where they see them. But importantly, particularly if you're a sort of liquidity provider from a proprietary perspective, it's often slightly misunderstood around why you want to be fast. And there are memes around, market makers front-running people, but it's not true. We like these types of businesses want to be able to remove orders, cancel orders, and it's usually because they understand where the fair value of an asset has moved to, and they have orders that are not reflecting that, and they need to get them out of the market as quickly as possible. That is the key reason why speed's important.
Very good point to that aspect of also price discovery and the important role that plays. When you were setting up or taking a step back before low tech actually got going and you were thinking of doing this, what were kind of some of the things in the checklist, so to say, that you said, we have to do it this way, we have to have this, we have to have this, to be able to operate like we want to when it comes to...
The infrastructure to bring data in and make rational decisions across different trading venues was key, and that sort of cascades into all the things we've talked about, like the ability to connect quickly to new venues, have the data into our system in a shape which is the same as data coming in from other venues. We wanted to do that because we'd had frustrations in our previous parts of our careers where that was just a hard job, and we have to pull data from one source, get it into a format that makes sense, pull data from another source, get it into a format that makes sense. And that's just for research purposes. That's let alone what the actual trading system is having to do as well. And so that was a fundamental piece of what we wanted to build, was something that allowed us to operate very seamlessly within our trading stack, but also from a research perspective. But there were other sort of business-related things that we wanted to do importantly as well. We're building for the capital markets future where everything is on chain. We want to be, and we will be, one of the biggest players in that space. To do that correctly, there are things that need to be put in place around entity setup, regulatory approvals, and all these sorts of things as well. And so being the old man amongst the three of us founders, that's sort of a path that I've trodden in my TradFi career as well. And so those are things that from a business perspective, we were keen to get right and put in place. We didn't want to go 2 years of building and then suddenly find that, all of the trading we've been doing has incurred sort of huge regulatory problems or tax problems and all this sort of stuff. So tricky as a startup initially to be able to find the right advisors, and the right advisors that are willing to give a good quality of advice for a price which is a sensitive to a startup. But it's essential, because if you don't start out on the right direction, it's very hard to sort of fold it in later on. And so that was something we wanted to make sure we got right as well.
But then just double clicking on the actual infrastructure, bare metal, stuff. I think the first time we talked, or one of the first time we talked, you were moving into a new office and putting, I guess, the servers in place and all of that kind of stuff. So that was a lot of picking and choosing and buying things, putting all the cables in place, and in a way, in a sense, to do something that hasn't really been done before, or hasn't been done very well up until this point.
So we're lucky in that, as you know, certainly in the crypto native world, almost everything is cloud-based. Mm-hmm. And so we've taken servers, like hard servers, into our office, mainly for data reasons. And all of the trading that we do currently is deployed to the right regions and areas where you can get as close to the virtual matching engines of the venues that we're trading on. There will be a world in which at some point we are doing genuine hardware stuff in data centers that we have to put servers in. Mm-hmm. We're not there from low-tech's perspective yet, but there are businesses that are, because there are venues that are in these data centers, like Deribit has traditionally had somewhere you can actually genuinely co-locate with. Mm-hmm. And that will be on our roadmap across the back end of this year as we look towards options as well. But yeah, from a startup perspective, it was okay, buy ourselves some boxes and then set up the right cloud infrastructure that allows us to deploy as seamlessly as possible. And the cloud is beautiful in the ability for it to scale. Once you get something that works, replicating it 1,000 or 10,000 times is one of the benefits of it. You don't have to buy. That's Jeff's problem. It's like, it's someone else's problem, how you scale that up. Now, they take a fee for doing that.
Sure.
But getting that knowledge and expertise was something that one of my co-founders spent a lot of time doing.
Mm-hmm. And if there are more low latency venues, shall I say, like RULEMATCH that provide super low latency, how could or would that change some of the strategic perspectives or focuses for you?
It's absolutely vital for us to be at the venues where price discovery is occurring and be able to take that information in as quick as possible. Mm-hmm. And so as venues like RULEMATCH become successful in terms of flow and price discovery, we want to be there. We have to be there. Mm-hmm. And so if that involves putting physical hardware into locations, of course we'll do it. Might need to get the right type of expertise into the business to be able to do that. But we're lucky because we've come from firms where we know people who might be interested in helping us with that.
Just tell us quickly before we move on about the team and the experience behind yourself, but also your co-founders.
So 3 co-founders in low-tech, myself, Marcus and Alex. We met at a options market making firm in London where we were part of building out a digital assets department. Mm-hmm. And we do have this sort of overlapping skill set of quant trading background, trading systems build-outs, which is me. Marcus is Cambridge Maths PhD and a quant who's done quant research and building trading systems, and is a very, very good developer as well at traditional hedge funds, businesses, and others. And then Alex is a trained developer who does things from a development perspective in exactly the right way. And so there's that nice sort of 3 skill sets that brought us together and allowed us to move very quickly when we first started. We built for a year infrastructure that allowed us to get to a point where we knew we had something that worked. Mm-hmm. And then it was a case of, okay, this works. How do we scale? And for us, we were lucky enough to get introduced to some very good VCs as part of that conversation. One in particular who helped us realize the true ambition for what we were building was vast, and invested in us. And from that point onwards, we extended the team to 7 now, almost all engineers. And we've been building nonstop since then. So that was early. Which year are we now? That was early 24. Mm-hmm. And we've ramped up infrastructure build to support these 2 businesses. We will be layering in other businesses that take us to being a full capital markets firm in the next 18 months. And the traction and success that we've had as we've launched these has surprised us in a nice way. We're further ahead than we expected to be, but we now are supporting clients who take our market data for their own uses, and we're supporting token projects and venues from a liquidity perspective. Again, it's happened faster than we expected, and so we're just looking to grow and expand some more.
Definitely. Just to talk to me very quickly about the geographical, or how you see the global market. You're sitting in London, but we're sitting here in Zurich today. Now, of course, some things have happened in the U.S. When you think about your own focus or opportunities, where do you look? Geographically?
Yeah, it's a really good question and something we think about a lot. So our UK base is where we write all our software currently. We trade out of a BVI entity, and we will establish other trading locations across the next year or so. For a while now, we've been talking about having a presence in either Asia, either Singapore or Hong Kong, I think. There's a lot of activity that goes on out there, particularly from a token, new token perspective. And going to some of the conferences in the region last year made that very apparent. The shift in tone in the US has brought into perspective a potential another route as well. It's something we need to consider. I think all businesses are considering that with what their business looks like with a more US-friendly regulatory system. But for us, crypto is completely global. It's on all the time, doesn't stop. And so our systems kind of reflect that. We are lucky to be able to deploy trading capability to wherever we need to. And we write software in one location, but it doesn't mean we have to trade there at all. And so we are trying to build the business so it can operate seamlessly around the world in all time zones. From a business perspective, it makes sense to have more than one physical location, just because crypto is not, it's not just Europe.
Sure.
It's not just Asia. It's not just North America. It is truly global. But as a growing business, we need to be quite strategic about where we make those first non-UK hires, and how we structure trading entities in relation to that.
Zooming back out just a little bit, I'd love to get your perspective on two topics, perhaps not so unique topics, but probably important in 2025. One is stablecoins. There's tokens, and then there are tokens, Bitcoin, Ether, and so on. And then there are stablecoins. There have been dominant ones, up-and-coming tokens. Now there seems to be more and more here, there, everywhere, Europe, US, some in other places. What do you think about stablecoins, trade in them, liquidity around them, usage, and how will you approach that?
Yeah, it's a good question. Obviously, it was a huge part of the back end of 2024 was the increase in issuance of stablecoins, and they are not going to go away from our ecosystem. I think it's been very hard, certainly sitting in my seat, to keep track of all the different launches that have happened. And so I think taking a step back, I've tended to now think about them as ways of mitigating credit risk within the system. And so what does a stablecoin look like in terms of how it's actually backed, but has become very important. From our perspective, we had the dominant player for a long time be Tether, which had loads of questions thrown at it around, what's the credit risk here, and is it genuinely backed? And whether that's been solved or not, I don't think anyone knows properly yet, but it is an established part of our ecosystem, and you can't ignore it or avoid touching it. So you have to make a risk-based decision on whether that's something that you'll interact with as a business. From a trading perspective, we have to, full stop. How we gain the knowledge and comfort in terms of all of the new issuances is something that we're going to have to consider sort of strongly as a business.
Because their transparency always plays a part, right?
Yes,
also,
of course. That's why they are effectively credit instruments, in the same way that you might think currencies issued by a central bank are safe, but they're only as safe as the country that's issuing them. Similar sort of thing. Where it goes and how it plays out in terms of the consolidation across the space, is something I can't predict.
Mm-hmm. And then just on the back of that, because it plays in a little bit, there is regulation. Part of that touches stablecoins, and we have some regulation coming in place for stablecoins in Europe. People consider how that might play out in the US. Switzerland has a slightly different perspective. But then when you talk about ethical market making, how much does regulation play into how market making is done or should be done? Will we get market making regulation in crypto? Where does that fit in the entire puzzle for you?
So it's something we obviously look at very closely, is the evolution of regulation in the different jurisdictions in relation to market making in particular, and liquidity provision and proprietary trading as a whole. And it's rare to get anything from a regulator which addresses that in a new environment directly. Tends to be quite, how regulation works. You set out, or there's usually an act of parliament or government or something similar, and then it's very broad, and then it gets defined down in detail. We think that, certainly from our perspective, wherever we choose to set up trading entities, we want to do that in a regulatory environment which is crypto forward, and has a degree of history in terms of enforcement of those regulations, so that they are setting a quality level that is good for us as a business, so that we can turn around to our clients and say, look, we've chosen this environment, you can contract with our entity there, because we know that in all previous history they've been crypto forward, and they've thought about this and this, and we've set up our entity to reflect that as well. And so I'm loath to say that we welcome regulation as a whole, but we welcome clarity and some degree of consistency. And I think that's where we're heading now.
And you alluded earlier to contracts, agreements when it comes to market making. I suppose you are also building on best practices from traditional asset classes and things like that when it comes to those contracts, right? So it's not maybe directly regulated, and yet it's building on the basis of what has been established.
Yes,
already.
Yeah, completely. When we put a contract in place with a client, there's a few things that have to go in there to protect the client, but also to protect our business. Even prior to that, we need to go through various KYC, AML processes that might not yet be regulatory mandates for us as a business, but we think are sensible business practice to protect our business and make sure that we're doing the right thing for the client as well. And so the onboarding process is taken from best practice from TradFi, and then once we've done that, putting an agreement in place, again, it is a case of initially having worked with good lawyers who know the space well and have seen the way that the regulator approaches this type of thing in the jurisdiction where we're contracting, and making sure that everything is as clear as it can be in terms of all of the potential situations that occur. As you know, agreements are usually there for when things go wrong.
Bad,
yeah. And so making sure that that's in play and in place for both the client's protection and our protection is the way that we go about those things.
And then just as we finish up, backing up or zooming out even more, we always ask our guests at the end, looking forward into the next 6, 9, 12 months, maybe not so much at low tech, but in general in the market, is there something that's going on that people haven't talked about very much, or just a few people are talking about that we might want to keep an eye on that you think could be interesting?
And I'll give you two. One, and I these are rabbit holes that I go down, so I don't know if people are talking about them or not. One is with a more sort of traditional finance perspective. I think the use of perpetuals within crypto has opened the eyes of some of the traditional derivative exchanges to another potential asset class or structure or instrument type, instrument type, that they haven't really used on exchange basis before. So You can argue about where perpetuals came from, whether it was an FX thing or a CFD thing, or whether BitMEX generally did the first one. But the fact of the matter is they've been the dominant vehicle within crypto for a while now. And so I think you'll probably see in maybe 6 to 12 months some of the less dominant derivatives businesses within TradFi exchanges begin to think about listing genuine perpetual contracts as a way of gaining market share. Yeah, for traditional asset classes. Yeah, for digital, like an equity index or something. There's all sorts of mechanics that they'll need to change on the back end around settlement and margining and all that sort of stuff. But the popularity of them within crypto must be interesting to those businesses.
Sure.
And the fact that crypto and the crypto firms that have become successful are beginning to look at traditional asset classes as well, and will have an expectation about these types of assets being there, so they don't have to roll every 30 days or every 90 days or quarterly rolls, all this sort of stuff can go away with this type of product. So I think that's one from a TradFi perspective. Crypto, and again, I've got no idea whether this is too big a thing. I think the smashing together of crypto and AI is something that will continue to be a very interesting hole down which to travel.
When it comes to tokens, or when it comes to
protocols, tokens, yeah. If you think what blockchain is, I mean, if you looked at a blockchain piece of data, it's very hard to decipher. If you use Etherscan or something, you really need to know a way around what you're looking at information-wise. But that to a computer or to an AI, that's the type of information that it wants. And so as you have independent AI agents, their method of paying for things naturally should be a blockchain-based token, and so that will continue to evolve. And I think we're beginning to see interesting autonomous agents use crypto as a way to facilitate the services they've been set up to do, or speculate, or et cetera, et cetera. But that will be an interesting experiment to watch. I hope it doesn't wreck the markets, but there we go.
Yeah, well, we have to be prepared for everything. This is crypto after all,
yes,
right?
Exactly, yeah. We should be seeing a lot, but we haven't seen everything.
Yeah. Tim Meggs, thank you very much for joining us today. It's super to have you on RULEMATCH Spot On. I'm sure in 12 months we'll have an opportunity to speak again, and you'll tell us some more interesting things of what you've done or what you're seeing in the market. Thanks very much.
Thanks very much, Ian. That was great.